You can be profitable on paper and still go broke. I've seen it happen to businesses doing $1 million a year. Great P&L, empty bank account. If you've ever looked at your numbers and thought,
we're making money, so why am I stressed about payroll?
You're not imagining things. Profit and cash flow are not the same. And missing that difference is the #1 reason I see good businesses fail. When I sit down with clients, this is usually the first conversation we have. We've grown from 0 to over 25 people in 4 years, and we manage thousands of Australian businesses. So I've seen what works and what quietly kills a business before the owner even realizes there's a problem. And I'm about to show you exactly what that is. By the end of this video, you'll know where profit and cash split apart, the 5 traps that drain cash from profitable businesses, and the simple monthly rhythm I use with clients to spot trouble before it hits. Here's how we'll break it down. The real difference between profit and cash flow, the 5 cash flow traps that catch even experienced business owners, the weekly and monthly rhythm to stay in control. Trust me, you don't want to miss these insights. It could be the difference between a flourishing business and one that goes bust. Now let's get into it. First, let's define these terms in plain English. Cash flow is the money that's actually coming in and out of your bank account. It's real time. It's what you see when you log into your bank. It's what pays wages, bills, and keeps the lights on. Profit is revenue minus expenses. It's an accounting result. If you're running your accounts on an accrual basis, which most businesses do, you might have invoices out that haven't been paid yet. That's paper profit, not cash in your hand. Here's the rule of thumb to define whether money is profit or cash flow. Profit, did you earn it? Cash flow, can you pay it? You need both. But if you only watch profit and ignore cash flow, you can look successful on paper while your business slowly suffocates. Now let's run through the 5 biggest reasons a business can be profitable and still be cash flow poor. For each one, I'll show you the trap, who gets hit the hardest, and what to do about it. You could be falling for one of these traps right now and not even know it. So listen carefully. Trap #1, accounts receivable, getting paid late. You do the work, send the invoice, and wait. On your P&L, it's revenue. In your bank, it's nothing. I see tradies all the time fall victim to this, as well as agencies and other B2B service-based businesses that invoice after the job. I had a client running a building company. Great profit on paper, but they were waiting 90 days to get paid while paying suppliers and wages every week. On paper, they were winning. In reality, they were one late payment away from disaster. So here's what to do instead. Set strict payment terms. 14 days, not 30. Use direct debit or upfront deposits wherever it's possible. Automate your follow-ups. I use Chaser HQ with clients, emails, texts, phone calls, all on a schedule. If someone's 60 days or 90 days overdue, get on the phone. Offer a 10 or 15% discount to settle it today if you have to. Don't just write it off. The biggest red flag, your receivables are consistently over 30 days. You're funding your client's business with your cash. Trap #2, inventory, cash trapped in stock. You buy stock, it sits on the shelf, and your cash is locked up doing nothing. E-commerce, retailers, wholesale are prone to this. To get around this, understand your supply chain. How long does it take to order, receive, and then sell? Set reorder points based on real data, not gut feel. If stock isn't moving, run a fire sale. Cash sitting in a warehouse is costing you money. And if you've got months of inventory gathering dust, that's cash you can't use to grow. So make sure you find the middle ground. Trap #3, capital expenditure, big purchases. You buy a vehicle, equipment, or fit out your office. The cash leaves your account immediately. Only the depreciation shows up on your P&L, and that's spread over years. Again, construction businesses, trade businesses, and anyone scaling quickly are likely to make this mistake. I see this a lot with tradies. They want to bring on 3 new staff members, so they need 3 new utes, fit outs, and tools. This could cost over $180,000. Cash, gone. The P&L won't show that hit until the depreciation starts to kick in. So do this. If scaling is a priority, lease or finance instead of buying it outright. Yes, you'll pay interest, but that's the cost of keeping cash in the business. Keep a buffer so you're not wiped out by one big purchase. If you're making a major purchase without a cash flow forecast, you are flying blind. Trap #4, debt repayments. Loan repayments, especially the principal, don't show up on your P&L. Only the interest does. But the full repayment still drains your bank account every month. If you're a business with asset finance, equipment loans, or overdraft, you might be guilty of forgetting to forecast with your debt repayments in mind. Do this instead. Track every repayment in your cash flow forecast and watch out for balloon payments. They can sneak up on you. If you've got assets that are fully paid off, you can actually refinance them to inject cash back into the business. And most people don't know that that's an option. The bottom line, if you're surprised by a big repayment, your system needs work. Trap number 5, tax and timing shocks. BAS, GST, PAYG, super, income tax, insurance renewals, they all land at once and often when you least expect it. Most people get hit by this one, but especially business owners who don't set money aside. I see this constantly. A client comes in when we do their BAS.
Why is it so high? I don't have that money.
The truth is, they've spent it. That GST, that PAYG, it was never theirs to spend. To avoid this stress, set up a second bank account. Call it your tax account. Every time you need to do payroll, transfer the PAYG and the super into that account. Every time cash comes in, transfer 10% for GST and future tax. When the BAS is due, that money is already sitting there, no stress. If you're scrambling to pay the ATO every quarter, that's the biggest fix you can make. Now that you know the traps and understand what cash flow versus profit actually is, let's look at the difference between the clients who grow and the ones that go broke. The ones who grow do this one thing every single month. The ones that go broke avoid it until it's too late. It takes 20 minutes and it saves businesses hundreds of thousands of dollars. Here's what you need to do. Monthly, at an absolute minimum, sit down with your management accounts. Xero has a built-in management report, so make sure you're using it every single time you do go over this. Check your revenue, operating costs. How long is it taking us to get paid? Staff costs, accounts receivable, accounts payable, and short-term cash flow. And here's what to look for. Receivables creeping past 30 days, a cash buffer below 3 months of operating expenses, big tax bills or loan repayments coming up. And the tools that I use for this are Xero for management reports, Chaser HQ for automated debt collection, Fathom for cash flow forecasting with larger clients. If you don't understand these reports yet, that's fine, but make it a priority. You can't make good decisions with bad data. If your bookkeeping is a mess, none of this works. You need to get that right first. So what does a healthy cash flow versus profitable business actually look like? Well, there are a few criteria you need to keep in mind and check over and over again. A cash flow buffer. Aim for 3 months of operating expenses. 6 months is even better. 12 is the gold standard. You don't have to get there overnight. Build towards it. Receivables, under 30 days direct debit is the gold standard. Inventory, move it fast. Don't let cash sit on the shelves. Debt, know your repayments. Plan for balloon payments. Tax, never spend the ATO's money. Keep it in a separate bank account. Keeping an eye on these will ensure you're never poor on paper. If you take one thing away from this video, it's this. Profit is not cash. Revenue minus expenses is cash, and they're not the same. If you understand that and check your cash flow before every big decision, you'll avoid the trap that kills most businesses. If you want to see exactly how to read a balance sheet and spot cash flow problems before they hit, that's what I cover in the next video. Click here to watch it now. See you in the next video.